Stats Canada just released the latest inflation numbers, and let's get more now from Garnet Anderson, Head of Portfolio Management at Tacita Capital. Garnet, thanks very much for joining us today.
Thank you for having me.
I guess down, a little bit down, especially in the core.
Well, a little bit of the core,
just not a huge amount, but
not a huge amount, but a little bit of a positive because that's been relatively sticky on accommodation, on because you take a look at the core, you're taking out really the food, which has been quite volatile, and energy, which has been all over the place. And when you take a look what the Bank of Canada tends to focus on is on those core, the trims and the medians and so on and so forth. And they've been sticking up at that 2.8, 2.9%, nowhere near where we were back in 2022 and early 2023, but still not down to that 2% range that everybody's really more comfortable with. So that stickiness, and you even see that some of the stickiness come through on the wage growth front, right? And it's been particularly in the services area as opposed to the goods area. There was a little flip this particular month. So ideally, you'd like to see that come in a little bit more. Because right now, if you're sitting there as a bond investor, you're kind of going, okay, well, I'm getting yield, I'm getting some downside protection, which we can chat about. But really, it's my inflation target. What's my real return going to be? And you take a look at the general consensus of the economists, it's 2% for next year, 2.1% for 2027. And now that is mainline CPI as opposed to core, and mainline CPI is in that 2.2% area as we saw today. So because core can feed a little bit over into total CPI, just want to see that core come in a little bit more. And we certainly see from the States where that's revving a little bit high as well. And so when you take a look at the futures rate today, the information that came out, it hardly moved the probabilities around a Bank of Canada cut in the January meeting. And in fact, all in Q1.
It doesn't look like anything for. I mean, you were talking about a raise at one point, right?
Well, yes. If you look at the forwards, it's actually over the course of 2026 that probably suggests there's more of a probability of a hike as opposed to a cut.
Yeah. So
that's where again you've got a little bit of stubbornness, and we did get that positive GDP read for Q3. I mean, there's folks that poke holes out in, and probably legitimately. But that was a little bit of a positive surprise. Some decent numbers, all things considered, on the employment compared to where we were talking back in the spring and thinking what the world was going to fall down.
April was an unusual month, shall we say, especially in this. But it seems like the country has kind of bounced back to a degree.
Resilience, and I mean, again, when you think about the role of inflation, it permeates. We saw in 2022, if you get a spike in inflation, it cuts the knees out from every asset class, except for maybe gold and maybe cash. We saw bonds get hammered, we saw stocks get hammered, real estate get hammered, infrastructure get hammered. So really, and that's more of a pervasive effect. So if they can kind of keep a lid on that inflation, then that helps support all those areas. And in particular, it makes bonds a little bit more palatable. And why talking about bonds? They're not particularly exciting most of the time. They get a decent real return.
Sometimes solid doesn't have to be exciting.
Well, exactly, because people are running around saying, well, are we in an AI bubble? And certainly in Canada, when you take a look at our market, Canadian market did fantastic. So far in 2020, realize it's glass, not wood, but so far in 2025, but that was really, a lot of that's pumped up by gold. So again, it's a commodity trade. No, it's not iron, it's a different kind of commodity. So if people are worried about some of the valuation levels and some of the growth rates and some of what USMCA renegotiations could occur in 2026, just a little, reminder. Maybe take a look at the bond side, maybe do some rebalancing. The real return there is not bad. Again, as the real return as measured with historical.
What are we seeing for real returns then?
Well, right now, if you take a look and you say, okay, well, the 2 years at 2.6, the 5 years around 3, the 10 years, this is Canadian government, and around 3.5. If you went provincials, you can, without hardly any extra credit risk, you can pump that up by 0.2%, give or take. Then if you take off your 2.2%, now that's historical inflation. Bond investors only care about front windshield stuff. And again, if the economists come out and they're correct, and that's around 2%, those are decent real returns compared to kind of the 25-year average there. So the bond, this isn't like going back before COVID when interest rates were like less than 1%, negative halfway around the world. And you're just looking there going, I don't understand why I'm owning bonds. We're going to go really light on bonds. So bonds have a place in the portfolio, particularly those worried about valuation levels on the AI trade stateside. And then you've got the decision, well, what kind
of bonds?
What kind of bonds? And if you take a look at the main benchmark, so a lot comes down to credit. Okay, most people buy in a basket, so credit isn't a massive concern. Where it permeates is when we had the COVID March, and corporate bonds just got eviscerated for all about 3 seconds, and then they came back. But you saw that period where corporate bonds did get hurt. As long as you held on, you were fine. So do you go long duration, higher interest rate sensitivity, thinking that we're going to go into recession and you get the bigger pickup there? Probabilities of recession now in Canada, 30-35%. That's not a super high probability. Yeah, so that's probably not the trade. So we're a little bit shorter duration than the benchmark, and the benchmark's up at 7, a duration of about 7. We're lighter, we're more around 5 duration, just in case inflation peaks its head up a little bit more. And we're not giving much in the way of yield to get there, and it gives flexibility that if there's a stock market setback, we have some capital, step in,
jump back in. And where is that all Canadian, or are you looking to?
We do. We have. I mean, we run through the spectrum. We run through a spectrum of investment grade Canada, and the reason Canadian bonds are important for Canadian investors is really collective risk. Is you have to over the years keep pace with Canadian inflation. So Canadian bonds are decent over time to do that. And again, when you take a look at the returns, and while you can hedge away currency risk, if you've got a bunch of foreign bonds that are unhedged, sheer shifts in FX can just swamp any fixed income return you thought you were going to get. So we do have some global fixed income in there as well. We have some high yield, and we have some preferred shares. So again, blending that out.
And we almost out of time, but I want to get to. I didn't realize this went quickly because we were talking about the bonds. But a couple companies you want to talk about. Boralex.
Well, Boralex is, I've had a chance to chat with you before, and often it's around a stock that's at its peak, it's at its 52-week high, and we're going, great company, but just is it the time to go in?
Yeah.
Boralex is a little bit different. It has been beaten up. Its drawdown right now is in the 50% level. It's well off. It's off what it is, 12% year to date.
Yeah.
Its valuations are relatively cheap. Now, you don't get cheap without a reason. It's disappointed on the earnings front from its wind farm oriented. So they've had substandard conditions there. It's got hydro, it's had substandard conditions there. They do have a growth platform. It's not going to be a turnaround story in all one fell swoop. They do have a growth objective. And analysts are very pro on it. Like you take a look at the price to the 12-month target, it's like 45% upside. Don't think we're going to get the 45%. It'd be nice if we did. I don't think we will. But it might be a stock that if people say, okay, I'm going to start to edge in now, 2, 3, 4 years out, they can walk out their plan, minimize the number of negative surprises. Might look back and could go, not a bad entry point.
Okay. We're going to have to leave it there, but Garnet, thank you as always for joining us.
Thank you.
That was Garnet Anderson, Head of Portfolio Management at Tacita Capital.